Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. Andrew Hall, Matthew Krebsbach, Ben Nye. How's it going, guys? Chill and well. So happy to be here. Fun week here. We're doing lots of earnings reports and reactions and previews and all that good stuff for a bunch of stocks. We're going to be out of town. We're going to be in Chicago for a conference middle part of this week. So follow us on Twitter at Tusk Media LLC. We're going to give you all kinds of updates. Going to the Investor Kids Conference.
Love the kids.
Love the kids. We love the kids here. So doing what we can to help them out. Also going to eat some pizza. Maybe drink a beer. We'll see. But we're going to do a beer review.
After work hours.
We're going to do a beer review and a pizza review live from Chicago on Twitter. So you're going to want to watch that for sure. We're going to review it 1 through 10. And it's just going to be a tweet. You're not even going to know what we're eating. But it's just going to be pizza. 7. So whole numbers only. So we're going to do that. It's going to be a lot of fun. Riveting content. Content is king here with Tusk Media. So check it out. Lots of podcasts too. Hit subscribe. Follow us wherever you are. Lots of earnings previews. Let's see if we can nail them all. We're about to do Under Armour as a recap. Polaris, Twitter, Amazon, Google, Boeing, Apple, CCMP. I'm missing some here. Chubb. That might be it. That's 8. I think we did 9. So we're missing somebody in there. We may never know who we're missing. But so lots of previews on there. If you're on Seeking Alpha, follow us. Again, follow us on Twitter, YouTube, all that good stuff. Hit subscribe. And we're on iTunes. So if you're watching the video and you're wanting to leave, go home for work, subscribe to Tusk Media on iTunes. Just search Tusk Media. You can download it. It'll show up right there every time we put something up. So check it out. Jumping in, Under Armour. Woo! Rough day. Rough day for Under Armour. Potentially the worst day in Under Armour trading history. The worst day previously on record, they were down 11.25% in one day. Right now, they're down 13.3%. They were down more than 16% early. Not a good day. We talked a lot about earnings. We talked a lot about expectations. But with Under Armour, it really wasn't so much an earnings problem. It's kind of a projection problem. So to hit some of the stuff that might sound good in terms of a headline, or if you just read the wrong stuff and looked for the wrong information on this company, 28% increase in quarter 3 profit. Revenue is up 22%. EPS, so earnings per share of 29 cents versus a consensus estimate of 25 cents. So those things all sound really good. But then this is a growth story. We got bad news in terms of growth. The quote I have, and I know you have a lot more, is that growth rate going forward will be less than expected. Ben, what are you seeing, man?
Yeah, I mean, I think you hit on the key point, the key issue, that growth is less than expected. Margins also will take more time as a result. So it was interesting to me because the results came out at 7 in the morning, and the stock trades thinly, but it does trade in pre-market trading. The stock just wasn't moving very well because, I mean, the numbers were fine.
Yeah.
Conference call was at 8:30, so imagine, you own the stock, look at the results, say, okay, I'll come back in for the conference call at 8:30. 8:15, they come out with an 8K, and usually they do this, after you file a press release, you file it with the SEC, and you file your 8K. In the 8K, they had the prepared remarks for the conference call. And I'll just read you some of the remarks. Again, they had been looking for $7.5 billion of revenue, and $800 million of operating income by 2018. They say they're still on track to achieve the 2018 revenue goal of $7.5 billion, but the margins are weak and they are seeing that slowing growth. They're saying North American apparel growth is slowing across the industry. Growth rate going forward will be less than expected, as you said. Meanwhile, instead of just trying to milk the earnings a little bit more and juice earnings, juice margins a little bit, they say they're still going to invest to maintain superior growth rates while gaining share and scale, and they're doing this across their businesses. They say beyond 2018, they're on track for $10 billion in revenue. the scale will allow them to increase margins, and that'll have a salutary effect on the earnings, and et cetera, et cetera, et cetera. Bottom line for this company is, if you want to make a return on your investment, you have to have a view where you hop into your time machine and you go 10 years in the future. And if you have concerns about doing that and taking that leap of faith with Kevin Plank 10 years in the future, then you're going to have concerns with the stock. So today's announcement, Plank basically said, what we've been telling the street is wrong, or has been downgraded. And so that he's lost confidence with a number of people in the street. And you're seeing price targets, for example, at Jefferies downgraded to $34 from $42. At Stifel, cut to $33 from $53 a share as their target. So
not pretty.
No.
It's kind of one of those weird things. We were over here, we recorded a lot of podcasts today. I think this is number 8. They're all getting scheduled weird and coming out. I don't know how intern Barrett does what he does in terms of his madness, but there's some methodology there apparently. But I just remember, I was watching Under Armour die at 8:15. What's going on Twitter? And everybody was just beating the stock up and going through it. And now we're watching it kind of happen in real time. It's rebounded a little bit from there. But Kresbach, what are your thoughts in terms of, I think the two storylines that are compelling to me beyond just what Ben just talked about, but number one, I'm putting you on the spot, we didn't even prep for this at all, but number one is kind of the bankruptcy stories with some of the sports retailers, Sports Authority in particular, that are putting margin pressure and almost forcing creativity, it seems like, for Under Armour. So that's storyline number one. And storyline number two is just, I guess the tangent to that is how much money they're spending to get their apparel out there, whether it's acquiring rights. They have the big deal, I think it starts in 2021 with Major League Baseball. They'll be the uniform supplier. So taken over from Majestic, which has had that contract for a long time. Seems like they're spending tons of money to grow, continuing to do that, and having to get more and more creative, but how viable is that?
Well, in terms of the bankruptcy thing, I think if I was to buy Under Armour today, I think that would be the one silver lining I could look to and be comfortable with buying Under Armour and be like, well, let's say this is ending that.
The worst is behind.
Yeah, going forward, that head will kind of abate, and you can kind of rely on sales increasing at a higher rate. I remember a couple months ago when Sports Authority initially went out, and I think they cut their guidance a significant amount, and I think maybe we initiated positions there, the small ones that we have.
Right.
And we rebound a little bit.
Yeah.
But I think that's a good bullish case. And then the case of margins, right? That was your other question? Right.
Yeah.
I think I always go back to comparing Under Armour to Nike, at this point in Nike's history. Nike made $1 billion in cash flow to Under Armour's projected negative cash flow for another 3 or 4 years, and Under Armour spending an insanely amount more money on with a much lower base to make money from than Nike is. Today even,
right.
Nike can't afford to pay Steph Curry, or I guess in their case LeBron, I don't know, $500 million.
Yeah.
But Under Armour can't really afford to pay Steph Curry that same amount, or to get UCLA or to expand into Asia. You just don't have that money, and now they're committed that much money. There's no profit to be made there to me.
Yeah, it almost reads a lot more like the kind of growth story you would expect in the tech sector.
Yeah.
In terms of acquiring these technologies or products, which instead of doing that, they're actually just acquiring rights to license things. But they're just buying and spending like crazy, it seems like, at this point. And that puts so much pressure on market.
And then another side to that too is they even came out and said, correct me if I'm wrong, but they expect sales to increase from footwear.
Yeah.
And they expect footwear margins to be lower than the apparel margins. So you have everything's just killing margins.
Which is crazy too, because we were talking about this it seems like footwear should not be that expensive to
Intuitively, that's what I was thinking too.
And then also they've done so much in the realms of, I remember reading the article about how they want to start 3D printing footwear and components of their footwear to make it more and more cost effective and increase margins, because they'll be able to produce domestically and all of those things. And it just kind of seems like everything that Plank has really been selling is starting to come out to be less and less realistic.
And there's always this kind of deal of reading into actually what the CEO is actually saying. So when you say, they really want to grow the footwear business, for instance, they might sell that as, well, our footwear business is strong and we really want to capitalize on that. Cynics might say, well, their apparel business is just not catching on, it's not winning share, and for that reason, that's why they're allocating more capital to footwear. So especially when you're dealing with these promotional CEOs, which is not always a bad thing. You hear promotional CEO and you think, oh, let's run away. But I mean, John Ledger is a promotional CEO, and he's grown T-Mobile. When a couple of years ago they said they were done. Kevin Plank at Under Armour he's grown a business.
There's definitely a prestige to Under Armour,
right?
And
I'm a big fan of Under Armour.
I'm a fan. I like Under Armour stuff.
Yeah.
And that's I mean, maybe part of the odd bullish case is that maybe this is a growth story that can translate at a rate maybe that didn't apply to Nike. I'm not saying that it is, but maybe that's some of the appeal, is the idea that, hey, this is almost more of a lifestyle brand, more of a, more prestige to it than competitors. I mean, that would be, if I'm truly bullish on Under Armour, I would think that would have to be part of my case.
Right. Would you be interested in buying the stock here, or what would you?
I don't mind it here, again, as a true 10-year play. Am I going to make it a core position for any client's portfolio? Certainly not. Am I going to even add to any positions existing for clients? Probably not. The clients that I do have it for primarily are younger clients with a longer time horizon, and it is much more of a kind of
it's almost
a flyer. Yeah, exactly. I mean, I do think it's attractive here with the idea that, hey, what can happen over the next 10 years, even just narrative-wise. And that is the good thing, I think, for Under Armour, is they are in a position to change the narrative. Right now the narrative is very negative, it's bad, but it doesn't take a whole lot to reshift that. And I think they can kind of refocus and reconcentrate. And does that lend itself to huge outperformance numerically in the short term? Not necessarily, but they are doing well relative to expectations numerically as is. So if you can shift the narrative away from, it's not going to be quite what we thought it would be, hey, 2018 we're still going to hit this number that we thought we would, to maybe, hey, we're actually going to slightly outperform on the top line. Margins are still getting suppressed, but we can outperform, actually figure out some ways in which we can capitalize on some creativity. But I think you could slowly shift that narrative, and because it does have kind of that cult following, both from a consumer and I think from a coverage perspective, I do think you could kind of get a residual rally. Whether that's found financially, I don't know. I doubt it in the short term, but I do think you could turn fortunes around in the next year or two.
And you see that all the time. I would say quarter. I mean, you saw that with Netflix. I mean, I think before earnings it was like $80 a share. Now it's at $120 just for a decent quarter, good net ads or whatever.
Yeah, I mean, Netflix is growing faster than expected, and that's all that matters.
Yeah, I mean, the issue that I would watch out for the most, so I'll just take the other side just for the purposes of disagreement here on the video.
Just go ahead and cut it off.
But I would just say, did they take down guidance enough?
Right.
Because as we talked about, the guidance downgrade was marginal, and it was highly qualitative. But, I mean, is that enough? And what happens when or if they do it again? They've already lost a number of sell-side analysts. I mean, will there anybody be left standing next time? And
I think another thing to watch on this is just kind of the read-through of just insider ownership.
Yeah.
There's a report, and I can't remember who it was on Twitter. I saw it like 8:15 this morning, so it was a long time ago. But it said 100,000 shares were sold, before earnings, so recently sold. So not a great insider number to be looking at.
And they're paying big capital gains on tax on that.
Yeah. So just something maybe to kind of continue to keep an eye on is just who's selling, who's buying, all that good stuff at Under Armour. I think that's all we got. You got any closing remarks?
Solid.
There we go. Y'all have a great day. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.